Hello, everyone. Welcome to video 5 for chapter 21, our coverage of sales tax. In the last video, we handled calculating our sales tax remittance based on the amount collected from sales and the amount that we've paid on purchases by taking our actual sales tax amounts at the given rates. In this video, we're going to go through a somewhat simplified, it's more of a quick method, if that's what it's called, the quick method, and it's a relief calculation that's only available for small businesses. So let's go through those details. The quick method is a method of calculating your HST remittance, but it's only for businesses whose total taxable sales within 4 quarters is less than $400,000. So $400,000 as far as revenues go is still considered to be a fairly small business amount. You will still collect the GST, HST at the normal rate. What the quick method does, it allows you to assume your ITCs. And it assumes these ITCs sort of based on a assumed gross margin for the type of business you own. I think the next slide goes into the charts. So if you have a service provision, it's assumed that the HST you will remit will be 3.6% of your tax included sales. So that 3.6, say the GST rate is 5%, that 3.6, the amount you'd remit, is the assumed net difference between that 5% you'll collect from customers minus the 5% you'll pay on purchases. Now, at HST, when it's 13%, we have a different rate for service providers that's higher because those sales tax rates are also being applied at a higher rate. So let me come back to this table in just a second as we'll go through the last part of the rule. It's the assumption for the quick method is ITCs for your recurring expenditures. So it's assumed that, okay, if you have a retail store, it's assumed that, you're expected that your gross margin might only be 20%. So for you to have sales at $100,000, it's assumed that your purchases were at 80,000. And so the ITCs are based on that assumption. Now you might not have that profit margin, but you're a small enough business that this quick method allows you to have that assumed rate, that assumed profit margin. But capital expenditures are not accounted for in the quick method. So if you have capital expenditures on which you've paid sales tax, you still need to track those payments for ITCs and you'll add them into your calculation. As part of the remittance rate, we can apply to sales tax, inclusive on taxable sales, a 1% credit on the first $30,000 taxable and zero rated sales. So 1% of $30,000 is $300. So our quick method tells us our amount owed. It's calculating a quick amount owed, and then we can subtract up to $300 for that first amount of sales tax. So the reason that we have 6 different rates in our quick method is because there's generally 2 types of businesses that sell products and businesses that provide services. So if I am a service provider, it's assumed my cost margins are going to be smaller. When I buy retail items, I buy, let's say maybe I sell Labubus. When I buy Labubus from a wholesaler, I pay, say, $8 for them. I apply a gross margin and then I sell them for 10. So my gross margin is fairly small, that 20%. But if I'm a service provider, let's say I deal with haircuts, if someone pays me $30 for the haircut, It's generally no direct cost other than my time and perhaps the capital expenditures for the chair, the scissors, and other materials there. So the gross margin for services tend to be much higher. So, the gross margin might be 60% instead of 20. So since service providers tend to have larger gross margins, or at least they have lower costs related to their revenue generating activity, then their rates, the amount they'll owe in sales tax is assumed to be higher because they have their sales, but they don't have as many costs to generate ITCs to reduce the payable. Whereas someone who deals in retail goods will have lower HST remittances payable because it's assumed they have higher costs that will generate allocating ITCs, thus reducing the sales tax payable. So that's why we have the two columns. Then we have the three rows because GST is 5%, but Ontario charges HST of 13%, and the East Coast provinces charge 15%. So we have this assumed calculation between service and retail at the three different sales tax rates. There is guidance with the CRA for cross-province calculations. Because if I have a business in Ontario, I'm purchasing my supplies at 13%. But if I'm selling those goods to Alberta, I'm only collecting HST or GST at 5%. So this gets more complicated when you cross borders, and the CRA does have guidelines for performing the quick method on cross borders. We're not going to go into that level of detail here in this course. This is generally an introductory course when it comes to sales tax. So we're just going to use these set rates. So whatever situation you're in the question, make sure you're applying the type of business and the correct sales tax rate for the question. So an example for the quick method, an Alberta business, which will only charge GST, provides fully taxable goods for resale. So they deal in a retail business. The taxable sales for the year were 125,000. GST included is 131,250. So that's taking 105% and applying it to the sales amount. The thing about the quick method is it's calculated based on the GST included amount. So if we have 125,000 in sales, we've collected from customers 131,250. And part of that is sales tax. So we'll take that 131,250. This is a retail business in Alberta, so we're applying the 5%. So we'll use that 1.8% rate. So we'll take 1.8% of $131,250. So that basic tax that we owe for sales tax is $2,363. From this amount, we get to reduce additional ITCs. We get a credit of 1% on the first $30,000. So since our sales is over that 30,000 amount, we can take the full 30,000 at 1%. We'll reduce the amount we owe by $300. We also have capital expenditures used exclusively for taxable supplies of 20,000. The quick method is only taking into account your recurring expenses. So our capital expenditures, we will apply the same method of calculating HST as we did for our original calculation. So 5% of $20,000, we have an additional ITC of $1,000. So that's being subtracted from what we owe. So the basic quick method calculation says we owe 2,363. Our two adjustments for the credit on the first 30,000 and our additional ITC means we only owe $1,063. That's how much we will pay in HST. I had a thought about, well, hopefully to come back to me. Oh, here it is. So ITCs claimed for current expenditures are included in income. So because this is assumed on the sales tax collected, what if we collected more or less than what we're claiming? Or what if we paid more or less than what we are claiming? Those amounts will be reflected in the income statement. So if we were to do a detailed list of our sales tax collected and paid, and we find the quick method has us paying a different amount, doing the quick method, maybe we're remitting less tax than we should be. That difference between what we've collected and what we're remitting will go into our income statement as additional revenues or additional costs. ITCs for capital expenditures reduce capital cost of capital property, which affects our CCA claim. So if we're claiming more ITCs, then that's coming out of our capital cost numbers, which will affect our CCA calculations. Yes, so let's go to the exercise so we can see it in action. Robbins Hardware operates as a sole proprietorship in Alberta and sells only fully taxable goods to customers in Alberta. So this is a retail store. Sole proprietorship sells goods in Alberta. So retail store, 5%, that's 1.8 from our chart. During the first quarter of the fiscal year, the business has sales of 42,500 and purchases of $21,000, both of which are before the inclusion of GST. So GST needs to be included in our sales amount in order to apply the quick method. So we'll have to multiply 42,500 times 1.05, and that 44,000 is what we're going to use in our quick method calculation. So we had to add that 5% to our total. So how much are we going to have to remit for HST in this situation? So our sales amount was 42,500 times 1.5% in order to put in the sales tax times that rate of 1.8%. So we are retail, and in Alberta is just GST 5%, so that's our multiplier. So 1.8% says we owe $803.25 in sales tax. But we get a credit on the first 30,000. So since our sales total is over $30,000, we'll get the maximum credit. So we can subtract from our owed amount $300. So we only owe $503.25. The next exercise, Guy's Boots operates a sole proprietorship in Ontario, sells only fully taxable shoes and boots, so it's retail. During the first quarter, Guy's Boots has sales of $56,100, not including HST. Current expenses, all of which are subject to HST, are $23,400. Notice in the last question, we had purchases of 21,000, but we didn't include it in our calculation. And that's because the quick method is accounting for the ITCs of purchases. So we really didn't need to worry about the actual purchases that we made. In this question, we're going to compare the result of the quick method and the regular method. So our regular method is concerned with our actual purchases made. Due to a major renovation of the store, Guy's Boots has capital expenditures of $42,000, not considering the HST. Compare the two methods. Assume there's no associated persons and that the HST inclusive sales were less than $400,000. So being less than $400,000 means we are allowed to do the quick method. So let's see which method gets us the best outcome. Under the regular system, the regular invoice credit system that Canada uses, we would take the total sales times the Ontario rate of 13%. So we would collect $7,293 from our customers. Our current expenses were $23,400. 13% of that is an ITC of $3,042. And we also have to consider the capital expenditures of $42,000. So we also get an ITC of $5,460. So these amount to a little over $8,000. So we're going to have a refund. We have a refund of $1,209. So our regular method, we're going to get some money back from the government. The quick method has sales of 56,100. we will multiply this by 113%. What this will do is this multiplication will get us to an HST included amount of sales. So our sales were 56,100 times 1.13%, 63,000 $63,393. That's the total income that we've collected. That's from the sales plus the HST collected. So we have an Ontario rate of 13%. It's retail, so our multiplier is going to be 4.4%. So 56,100 times 113% times 4.4%. Our HST that we owe is going to be 2,789. And then we get that 1% credit on the first 30,000. So we'll subtract 300. And the quick method only accounts for our current expenses. So our capital expenditure will still be calculated just as it was in the regular method. So we'll have an additional ITC of 5,460. So notice that when we apply those ITCs, the quick method gets us a bigger refund, $2,970.71. By doing this, so we would check our system. We would say, hey, which method is better? Since our sales are still below 400,000, we're allowed to use the quick method. And if it comes out to a better refund, let's get it. Let's use the quick method and do the refund. The thing about the quick method is if you use it, you're kind of required to use it for the next year. We'll have to use it for every quarter. So once we do it once, we get our refund. If the next quarter we realize the quick method gets us a smaller refund, we're kind of locked in. So we would want to sort of project out what do we think our sales are going to be, what do we think our costs are going to be, and kind of figure out which way we're better off. So if we find that the quick method is going to consistently get us a better refund, we can keep using the quick method until our sales get over that 400,000 in 4 quarters, and which point we'll be required to revert back to the regular invoice credit system. So this exercise was to demonstrate that the quick method doesn't always come out to the same result as the regular method. Sometimes it's worse, sometimes it's better. And if it's better, that's great for us. A small business probably wants that extra $1,700. Okay, so that is the quick method. There is an alternate method called the simplified ITCs. We're not going to go into this too much. Basically, you just tally up your expenses that apply sales tax and you just apply that 13%, say, one time. But I don't think we have any questions where we really apply the simplified the simplified input tax credit method towards you guys. So I would say focus on understanding that regular method for calculating HST. Try to understand the quick method. Those are the questions that are most likely to come up. I'm going to have one more video where we go over some of the compliance and administration rules. And I think for this course, that's where we're going to end it. Later on in the chapter where we go into more complicated sales tax situations like employee and partner and housing rebates, those methods of calculating sales tax are a little more complicated and I think a little bit outside the scope of what we want to accomplish in just the 2 weeks we have reserved for the sales tax chapter. So I'll have one more video where we'll go over some administrative and compliance rules for sales tax, and that's where we'll end the chapter. So there's going to be no expectation for you guys to read further on into those more complicated subjects of sales tax. Anyway, thank you for your time. See you in the next video.